So let's come to the topic of the day. So choose your Valentine wisely. I must compliment my team for coming up with such uh, uh, creative titles. So we are using today drawdown as a metric to understand how we can think of from a perspective of staying away from weakness and staying close to strength. So that is our sort of desired mental space to be in, that we don't want weakness and we want strength. That is a sort of a underlying thesis, especially for momentum investing, but even for otherwise. uh, Drawdowns is something that you know I think most investors don't appreciate the concept of deep drawdowns as much as they should. That is the sort of thought process that I have. And thinking about a stock that goes from 100 to, let's say, 70 versus 100 to, let's say, 50 or 30, the recovery paths are very, very different. I think that aspect is not appreciated, that what is falling like a rock uh, may not fire like a rocket on the way back. And the faster and steeper something is falling, probably is signaling that I'm extremely weak versus the ones that are falling less. So that is the whole idea. The drawdown, I mean, if some of you may not be aware, drawdown is basically just the measurement of the fall from the peak. So if stock went from, let's say, 20 rupees to 100 rupees and then 100 to 50, then the drawdown is 50%, going from 100 to 50 rupees. That is the drawdown. Going from peak to the maximum trough in any particular move. uh, the so what we will do in this study is that we will take these four indices: Nifty Next 50, Midcap, and Smallcap. We will study the current drawdowns of all stocks within each of this universe. We will take the ratio of that stock to that benchmark, how they have performed versus the benchmark, and some more stats within each universe to see where the strength and weakness lies. So let's take Nifty 50. The current drawdown is 11.5%. Actually speaking, Nifty has not done anything that is causing any alarm. 11% down on the major index is nothing basically. I mean, it is. Remember 2008, we had a 70% drop on Nifty. We are currently at 11.5%. So that, although there is a death cross there, and there is lower lows, lower highs, the chart is looking not so nice. But on an absolute basis, we've lost only 11.5%. Now, if we see the drawdown metrics, there are only 11 stocks that have done better than Nifty. So there are only 11 stocks that have not fallen as much as Nifty. 39 stocks have fallen more than the average Nifty fall. The average drawdown of all stocks is 20%. Remember, Nifty is 11%. All meaning all Nifty stocks. There are some stocks that are, even 1.5 times the benchmark drawdown. That's 52% of that. So if benchmark is down 11%, then more than 16 odd percent. If you see, there are 52% stocks more than that. There are some stocks which are three times more drawdown than the Nifty. uh, and of course, there are some stocks which have not fallen as much. So there are maybe 2% stocks, or essentially one stock that is less than 6% down. There's a three stocks that are less than 50% of the Nifty benchmark down, so on and so forth. If we look at the stocks themselves, so the current drawdown, if we were to see, Bajaj Finance, Bharti Airtel, Ultra Semco, ICICI, Infosys, Maruti, Mahindra, JSW Steel, Tech Mahindra, HDFC Bank, Bajaj, these all have beaten the Nifty benchmark of the drawdown from their peaks as of 13th of February. If we go further down on this chart, you will see these all stocks are weaker than Nifty, and there is a long list of things. And by the end, we have IndusInd Bank, Adani Enterprise, Tata Motors, Asian Paints, Hero Moto, Trent, all of which are weaker than the benchmark. And if we take that ratio of the drop of stock versus the benchmark's drop, this is the worst case scenario at 4.2. So that's most of the stocks. So the idea here being that the stocks that have the least sort of drawdown is where gradually your move should be towards, because these stocks are showing resilience, that despite the general market moving down, these stocks are saying no, we don't want to move down. That is telling you the relative strength of these stocks versus others. Now let's take Nifty Next 50. Nifty Next 50 actually is down 21%, which is much steeper than than Nifty. Although these are also large caps, but there's a big difference in the nature of Nifty versus Nifty Next 50. Maybe it is because of very high focus towards Nifty stocks in terms of all kinds of derivatives trading and structures around them, that the volatility reduces once the stock comes into Nifty, and so does returns. Nifty Next 50 is certainly in a downtrend. Yet to really make any mark on the uptrend. There's a death cross that had happened beginning of the year. If we look at the numbers here, it is as bad as Nifty. In fact, worse. Only 11 stocks in the Nifty Next 50 space are have done better than the average Nifty Next 50. 39 stocks or 78% are down below that, and you can see large numbers are there when it comes to much more drawdown than the Nifty Next 50 drawdown. If we see this list, you will find stocks like Divi's Lab, Bajaj Holding, Shree Cement, Indigo, Torrent Pharma, TVS, Chola, Naukri, Pidilite, United, Vedanta, uh, and you also have so basically these stocks are stronger than the benchmark right now, and rest are all much weaker than the benchmark. If we go down the list, we'll find that Adani Total Gas is 85% down, Adani Ensol is 82%, Union Bank, Adani Green, PNB, BHL are the worst sort of performers from this index. If we look at, okay, let's also look at yeah, so these are the stocks sort of which are leading the Nifty Next 50 space versus the index. In the mid cap 150 index, mid cap 150 index is down 15.7%, very surprisingly much less than Nifty Next 50. So mid caps actually have fallen less than the Nifty Next 50 large caps, but certainly this is also in a drawdown, also seeing a death cross there. 15.7 is the drawdown here, and only 9% of stocks are stronger than the benchmark, which is about 14 stocks. 91% stocks are weaker than the benchmark. So when we look at the index, it is only few stocks that is really fully putting the counterweight of strength versus the huge weakness that is there in that benchmark. So if you were sitting with the losers of that index, you will perform much worse than the index. If you were gradually moving into the strength of that index, you will start to perform better than the index, or at least be with the index. The average drawdown here of all stocks is 34% on midcap 150. If we look at the list here, you will see that Muthoot Finance, JK Cement, SRF, Abbott, Coromandel, Patanjali, UBL, Lupin, BSE, Marico, Bharati Hexa, Persistent, LTTS, Federal Bank. These have been, although they are also down up to 15%, but they are stronger than the midcap 150 index. And then you have a long list of losers, and the worst ones are right here, or maybe even worse. Yes Bank is down 95%, Idea is down 93%, Suzlon is down 87%, Bank Nifty, Bandhan Bank, IOB, all these are down big time from their all-time highs, and they are much weaker than the current benchmark position is. The fact remains that you may have a situation where something would have fallen much earlier than the current market fall. That is possible, but from a perspective of how what is the sort of drop or drawdown to make that stock go back to its all-time high, these are the sort of real big losers that are out there. So we'll quickly go through small caps also. Small caps are down 19%. You have only 10% stocks that are beating the benchmark. Average drawdown is 39% from the tops, and you have basically Reddington, Belcorp, Chambal, National Rudale, Karur, AstraZen, ISEC, Zensar, Kims, Manuparam, FSL. Some of these stocks are doing well. You can see the list here, right here, until 11 3. If I were to sort of see the worst case scenario, you have, MMTC, Network 18, Saman Capital, Z, Rajesh Expo, JP Power, Central. I mean, big losers in this list, and there's a huge list, huge running list. Tanla, which was a multi-bagger few years back, has lost 74%. I mean, this is very surprising. But SW Solar, big favorite of markets, Ease My Trip, HEG. Then you have, Honasa, Graphite, Happiest Mind used to be, fantastic stock. India Mart, Just Style, Root. So if you just avoid this extreme weakness by getting out of the stock when they start to fall or when they have fallen some way, you will really, save yourself from a lot of pain going forward. So this marriage, this is Valentine Day, so you need to not get wedded to stocks. I mean, it may sound a little funny, but you need to come together with your stocks only for some time, and not get married to the stocks. Marriage with stocks is very dangerous. The divorce from those marriages are extremely painful. They will basically bankrupt you before leaving you. And like I give the analogy normally, drawdowns is something that it just doesn't come naturally to our mind. So the analogy I give is that you are running on the road and you fall in a ditch. If it is a 3 feet ditch, you will come out and you'll start running again. But if it's a 30 feet ditch, you will get stuck there, and it'll be very difficult to come out, because going from minus 30% to 100% is just 40-45% of gain. But if you want to recover from minus 80%, you'll have to go 5x to come back to where you were. So this aspect, that don't allow yourself to go deep in the muck, is what is very important. It is better to take a loss and re look at your situation, rather than be a frog in the frying pan, gradually going deeper and deeper and deeper and deeper. That has to be avoided. um, so constantly evaluate if your marriage with your stock is working or not, and be realistic, be greedy, to get out and chase stocks that are running away. um, the you can remain married to the stock if, as long as it is working for you, right? I mean, it's giving you returns, you are liking it. The stock, I don't know whether it likes it or not, but bad decisions, bad marriage decisions, I mean, like just like in life also, the counselors will tell you, if you are having a bad marriage, there's no point elongating it for 10 years, ruining your money in courts, and then coming to that same conclusion what you could have reached 10 years back. So the idea is to be very clear what you are demanding from that situation. And if it is not going your way, then you need to get out of that agreement and look for newer pastures. It is Valentine's Day. Let me know your perspective on this. Thank you so much for watching, and do like and share these videos, and do subscribe to the channel. Thanks. Bye.